Hello, mortgage fans. So I'm back from a week refreshed from being in the beautiful island of Jersey. We were very lucky with the weather, so we got out to explore, hung out at some of the beaches, got to do a bit of surfing, bodyboarding, and just basically switch off for a week, which was really, really needed. It's not quite the Med, I'll give it that, but it's sort of nice having a lovely little island on our doorstep, so you don't have to worry too much about moving around during a pandemic. Also, if anyone has been to Jersey, they are pretty much a case study in how to manage people in and out of an island. So I'm just saying, that's a good way of doing it. Not quite how we did it. But anyway, downside to being away is the battle with your inbox. Something I've done really for the last year or so. I've had a really conscious effort to try and decrease my email traffic to increase my productivity because the two seem to be linked. So I think I was down to about 6 emails or so before I left. So a bit heartbreaking to start today at about 60 plus, and that does include me clearing out the crap each day as well. But is what it is. The good news is there was no dramas. The team did a fantastic job. Like I say, I could recharge the batteries, which was really, really needed. So coming back fresh and catching up with all the mortgage news from last week. So as much as I would love to bang on about the heartbreak of the Lions at the hands of the Box with their anti-rugby, or the huge success of Team GB at the Olympics. And if you remember a few weeks back, I did call the British boxing team to be the best out there, and it was the best Olympics ever. So I'm just saying on that one. And also the lucky cricketers with the break on the weather as well yesterday. But you didn't come here for sports news, you came here for mortgage news. So mortgage news you shall get. So the three main headlines we're going to run with this week are mortgage rates continue to fall again. The Bank of England holds rates. And finally, some good news for landlords with rents going back on the up, or bad news for first-time buyers. So it depends what side of that coin you're on, really. So to go back to the first point then, so mortgage rates continue to fall. It was Halifax this week, or end of last week, which brought out an absolutely ridiculous 0.83% two-year fixed rate. That's the usual caveat for best rates at this level, so you can borrow a maximum of 60% of the property value. There is a £1,499 arrangement fee, and they typically charge a £200 flat survey fee as well. To put this into context, and sticking with the Olympic theme, this is sort of like the time when Usain Bolt smashed the world record, won the Olympic gold for the 100-metre hurdles while jogging over the line, if anyone remembers that. That's what Halifax have done here. They have just smashed the competition. It's not even close. And not even just for the best deals for the market leading rates. What's really, really important for any market, really, but particularly the mortgage market, is the higher LTV stuff. So they cut the rates across the board. They're now market leading if you want to borrow 90% of your property value. Their rates start at 2.19%. And there's quite a few guys now well under 2.5%. In fact, the majority of the high street guys are really sort of sub 2.5% in the 90% area. That's very palatable pricing and literally half of what it was at the start or just after the pandemic struck. Some lenders actually withdrew mortgages at all with a 10% deposit. So they're now back, they're strong, they're well priced, and lenders want it. So this is the game I've been talking about for a while now of rate limbo. So banks just have to keep going underneath each other to get the best mortgage rates, to attract the best borrowers. That game doesn't seem to be sort of stopping anytime soon. Because the next main headline I want to talk about is how the Bank of England held rates last week as well. So I looked through the minutes of the meeting because somebody needs to, but reading in between that, and if you followed any commentary on this, the Bank of England unanimously voted to keep rates at 0.1%, so no surprise there, that was expected. But what was interesting is they also voted 7-1 in favour of maintaining the current quantitative easing policy, which I believe has a total asset purchase value of 895 billion. Now that was widely tipped that might be reduced, or we're going to look at start removing some of the fiscal stimulus we've seen since the onset of COVID. But there was no real inklings of that. So there was no noises about reducing it, and also the votes were very heavily in favour of the status quo. Now the main thing that drew out the meeting minutes, was that they expect inflation to peak at around 4% at the end of this year, but then drop back to the target level of 2% by the end of 2023. So obviously inflation is going to go up quite a lot between this year and then back down to the level that they target at, because they want to be around the 2% mark. Now that statement was really quite clear, and that leaves it really pushed off the table any talk of a rate rise in the short term. Some banks were predicting, I think HSBC and others were expecting 2 base rate rises next year. Some are even making noises about the end of this year, and it's pretty much put that on the back burner, because if the Bank of England think that inflation is going to go back to its target level without changing its stimulus package or without moving interest rates, it sort of suggests they're not in a hurry to do anything. So that's quite interesting. The thing is, it's very finely balanced, because the fear is, I've talked about this quite a lot in recent weeks, but the fear is that if we do tighten fiscal policy now, it will kill off any sort of resurgence we have in the economy. So things are very much on a knife edge, and it wouldn't take much to push that back the other way, to actually looking at moving rates back up again. So it's just a debate we're going to have to keep a really close eye on. The inflation figures are the really big one. GDP is the other big driver as well, so it's worth sort of looking at that. That's probably going to be the main theme between now and the end of this year, specifically in relation to how mortgages are priced. The simple reason being is if banks expect rates to raise next year and onwards, you'll start to see mortgage rates increase. If the expectation is rates are going to be pretty flat for the foreseeable, where we are now could become the status quo of most banks having to go under 1% to attract the best buyers, which is pretty bonkers. But if you want to borrow money, great time. The flip side of the coin on that one is if you're looking to save money or invest, it's just tougher and tougher and tougher. So that's why it's such a difficult dynamic, because if you can't get good investment returns, pensions are disadvantages, etc., etc. It's a really complicated one. But certainly for the moment, it looks like rates are staying where they are. So another main header then, that rents are on the rise. So it was a website, I believe, called Good Lord. They do some research on their members and sort of see where rents are going. They believe that rents went up in England by 10% just in July alone. They've put some average numbers, which we'll put on the website as well. So rather than talk you through that, you can sort of figure it out. What's interesting to me is always the regional breakdown, because, okay, 10% for England is great, but obviously we're a very regionalised country in how things work out. The Southwest saw the biggest rise of 24% in the month, which is mad. And the Northeast saw a 19% rise as well. So this is this sort of classic outflow out of London that we've been seeing, which is pushing demand around the country. There's probably a bigger dynamic on this in terms of house purchases as well, but I'll save that for another day. Other areas of the UK, if you're interested, the Northwest was at 11.5%, the Southeast as a whole 7%, East Midlands 6.8%, Greater London 4%, and West Midlands 3.5%. So up across the board, and the big gainers are the ones where that outflow of London seems to be the way, and this sort of hybrid working or remote working completely seems to be sticking. I noticed on Radio 4 today there's quite a bit of press coverage around, are people returning to work, are they not? No one's really sure how they're going to play that, but certainly as a small business owner and speaking to other small business owners, there's no huge agenda to drag people back in an office anytime soon. So we could well see that sort of level out over the course of the year. So last point then to look at is how that plays out into market rates and the mortgage rates themselves. So money market's pretty flat last week. What we did see was an increase in 2-year money. That was up by 0.33%. And a decrease in 5-year money, which was down 0.026%. Again, we put the figures on the website if you want to see how the trend's gone for the last couple of years. So over the last few months, pretty sort of flat overall, no major shakes. But that change in long-term money looking cheaper and short-term money looking more expensive just reflects what I was talking about before, is that if we don't think interest rates are going to step up steadily over time, we're sort of going to price that into how mortgages are. So I mentioned quite a few rates at the outset, but just as a quick recap, so the best rates available currently are for 2-year variables at 0.99, the 2-year fixed rate is at 0.83 as I spoke about, and 5-year money is down at 0.99, and if you're looking to get a buy to let, it's 1.19%. Standard caveat is dependent upon your situation and your deposit, will be what rate you're offered. So they are typically, if you're borrowing 60% or less of the property, as I mentioned, if you go up sort of 90-95% of the property value, probably looking near 2.5-3%. That's typically what you're going to be paying at the minute. So that's it for this week. Next week, I think we'll sort of touch on that dynamic around housing and house prices, because now the lending market's back in full swing and people are looking at moving, it's really showing up some major shortages. So that's the theme for next time. Have a good week. We'll catch up soon.